Okay, hi guys. We are back with the next chapter. What our next chapter is all about is we are going to talk about cost of capital. So as you can see here, I've given you my notes here. It's easy to understand this. Okay, it's very straightforward. There isn't any complication here. So what I want you to do is whenever you do cost of capital, I want you to revise using this note. So whatever I'm going to write, all right, if possible, of course, I'm going to write it in a different page altogether. But if it is possible, I would prefer if you would write it on this page. Okay, guys, if at all you cannot or you do not have enough space to write it in this page, what I want you to do is I want you to take an additional page and put it together with this page, or you can write at the back of this page. Okay, the reason why I say that is because I want to give you an environment where life is very easy for you to study towards exam. Yeah. So if you do it my way, trust me, it will be easy when you want to go for exam. When you want to flip through any notes, you just need to go through this specific notes only. All right. So here, cost of capital. So what I'm going to do now is, of course, guys, here currently I'm showing you cost of capital, but I also want you to remember that when I show you cost of capital, I would need to move to the next screen to write a little bit more. Okay, so I want you to copy whatever I'm going to write down, but at the same time, I also want you to focus on trying to copy it in one place. Example, I want you to be able to copy it in that particular page itself. All right. So now here, cost of capital. So before I continue, before I start talking, before I start explaining about cost of capital, hold on. Cost of capital. What is important is I want you to first know what is cost of capital, or why do we need to calculate cost of capital. So guys, I just want to give you a quick reminder. Why do you need to do this is because for the purpose of your examination, your examiner will require you to calculate the cost of capital. So when I say examiner requires you to calculate cost of capital, what does it mean? It means that the examiner would want you or would want you to know, would require you to know how to calculate cost of capital. Example, weighted average cost of capital. So number one, you need to know how to calculate it. Number two, you need to know the components of the cost of capital. Number three, you need to know what is the usage and how cost of capital is used throughout your entire syllabus. Okay. Now, so what is cost of capital, guys? When you think about cost of capital, whenever we used it in the investment appraisal, I'm sure in your mind is like, okay, I discount it at cost of capital, but what is cost of capital? And why do I need to discount my project at the cost of capital? So cost of capital is actually the return required by the shareholders of your company. Okay, when I say it's a return required by the shareholders of the company, it's not only shareholders, it's actually the return required by investors of the company, or another name that you can use is the providers of funds of the organization. So here, maybe I will type it down. Okay, so cost of capital Okay, so cost of capital is the return required by the investors of the company. So when I say it's provided or required by the investors of the company, or another name that you call it is providers of funds. Guys, I think I will continue writing. Typing is not my thing. So when you say it's the return required by the providers of fund to the company, whom are these investors or whom are the providers of fund? So the investors and the providers of fund can be divided into debt holders and also equity holders. Okay, so guys, now my question is, so what is the reason you need to calculate cost of capital? So the cost of capital is actually the amount of return that you need to pay to your individual investors weighted at or averaged at the market value of the debt. All right. So what you need to be sure about is that how to calculate it, because your examiner is not going to make your life so easy. He is going to make your life somewhat a little bit difficult. So when I say a little bit difficult, what does it mean? It means that he is going to ask you to calculate the cost of equity, the cost of debt, and then you calculate the weighted average cost of these sources of finance. So you can see the complication that the examiner is adding into your paper. So it's not actually that complicated, but what he does is he makes it complicated for you. So what you must need to know is, okay, what normally you must need to know is, you must know what is the formula to calculate your cost of equity, what is the formula to calculate your cost of debt, and how you perform these calculations. All right, so that is what we are going to learn in this topic. So now, there are two parts of cost of capital that you need to understand. Number one, this cost of capital can be said as the cost of the company raising funds. That means the cost that you need to incur in order to raise funds and to use those funds in your organization. So that's one definition of cost of capital. Another one is, it is also the return that you expect to pay the investors as a result of investing in your company. So you must remember, guys, the fact that they invest in your company, this will give them a right to earn return. Okay, so cost of capital is also the return that you earn for investing the funds in your organization. Now, therefore, what you can do is you can also call it, this is the minimum return that the company need to make from their investments so that the investors are able to earn this return. All right. So now, when we talk about cost of capital, you also need to understand that this cost of capital is normally used as a discount factor when, oops, sorry guys. It is used as a discount factor when calculating the NPV of a project. Why? Because once you calculate NPV is the net present value. That means the cost or the revenue that the company will earn. So after you calculate your net cash flow, you discount it at the cost of capital, because assuming you pay 10%, what is left for the company after paying the 10%? So this discount factor is also used as this cost of capital is also used as the discount factor when calculating the required, the NPV of a project. Okay, so it is used in the investment appraisal topic. Now, the next one, each form of capital has its own cost. Example, Cost of equity has their own cost. It's called cost of ordinary shares, okay, or cost of equity. Cost of debt can be divided into cost of bank loan, cost of bonds, cost of convertible bonds, cost of preference shares, and so on. So you must remember that the company need to make enough returns from their investment so that they can pay all these individual providers of finance. Okay, so to add on to this, so your debt providers are normally the bank loan, your bondholders, preference shares. Your cost of equity, guys, normally it's ordinary shares. Why? Because that's the only type of equity that is tested in your examination. Okay. Now, assuming he gives you reserve, then you need to know how to use reserves as well. Reserves. Okay. So what your objective is in this topic is to know how to calculate. You must know how to calculate the weighted average cost of capital. That is your objective. And in order to know how to calculate the WACC, you need to know how to calculate the cost of debt. You need to know how to calculate the cost of equity. So just be a bit careful when it comes to areas like this. All right. Now, so on top of that, the cost of capital can also or is also known as the opportunity cost. Why? What is the reason? Okay, because when you talk about cost of capital, it is the amount that your investors earn. So guys, think about it this way. If the organization, if the investor did not choose to invest in your company, they chose to invest in a different company. So what will happen is, if they choose to invest in a different company, they would have earned the interest from the other company. So if I want to illustrate it, so it looks like this. So let's say they have an investment opportunity in company A and they have an investment company opportunity in company B. So let's say this is your company. This is the third company. So as an investor, right? Okay, as a person who normally performs investments, you will choose to invest. The investor will choose to invest in your company over company A, which he could have chosen. So what it means here is the return from company A projects is actually an opportunity cost for you, because when they choose to invest in your company, they lose the opportunity to earn returns from company A. Thus, you must understand that the investor deems company A as an opportunity cost, the return from company A as an opportunity cost. So cost of capital, number one, it's the weighted average cost of capital. That means this is the weighted cost or weighted required return for all the investors of the company. It is a cost that the company will have to incur as part of raising finance for their company and using this finance. And number three, it is considered as an opportunity cost for the investors, because shareholders choose to invest in your company and not in another company. So you must be aware, okay, that when you talk about cost of capital, okay, there are three major elements, okay, that incorporates the cost of capital. So let me just add on a little bit more. Okay, so required return, cost of funds, sorry, cost of company raising. Okay. Using that, and then finally this is the cost opportunity cost. Okay, now, so when you talk about cost of capital, like I told you, there are three main elements. Okay, to cost of capital. So what are these three main elements? Number one, the risk-free rate of return. Number two, the premium for business risk. And number three, the premium for financial risk. If you add all this together, this is actually the cost of capital of a company. So what actually does it mean by rate of return, risk-free rate of return? Okay, so three main elements. Premium on business risk, premium on financial risk. Okay, so the three different types of return. So what is the risk-free rate of return? So guys, what it means is that this return, the risk-free rate of return, is actually the return that the investor will earn if they invest in an investment that is risk-free, that is not risky for the company. So normally the risk-free investments are government bonds, treasury bills. Okay, those are risk-free returns. Why? Because normally government bonds or government securities are secured, are highly secured, and hence the investor does not have to bear a high risk. So that is what you call a risk-free return. Now, when you talk about the premium for business risk here, so let me just write down this first. Risk-free rate of return is the return an investor will earn if they invest in risk-free investments. Okay, so normally these are return on government bond and treasury bills. Okay, the premium on business risk. Okay, what it means is that this is the additional amount that your organization, your company will earn because they choose to invest in a higher risk business. So let's say you purposely choose to invest in that particular business. Let's say you choose to invest in a business that has high risk in the market, the most risky business, what will happen is that because you are willing to take on that particular risk, you may earn a higher return. Okay, and business risk normally would be higher for different firms, okay, and different projects. And as a result of that, the uncertainty is very high. Uncertainty is very high. But due to all these functions, all these elements and variables, this will lead to your company being able to earn a higher return. So if you choose to invest in a more risky business, that is what will lead to your company earning a higher return, because you are willing to take on that additional risk. And the general understanding between risk and return is that the higher the risk, the higher the return of that particular organization. All right. Now, the next one is, okay, wait, let me just write this on first, okay? So this one, business risk, there would organization increase in risk as they choose a more risky business. As a result, the likelihood of the company earning higher returns is higher. That means they have a higher likelihood to earn higher returns because they are willing to bear that particular risk. The final one, okay, the final element would be the premium for financial risk. All right. This means that it relates to the danger of an organization having a higher debt in their capital structure. So the higher the gearing of a company, right, the higher the financial risk will be to the ordinary shareholders. And as a result, this would drive the investors to require a higher return, and thus it would increase the cost of capital of the organization. So the higher the debt, the higher the financial risk, and the required return for investors will be higher. This will then alter the cost of capital. When I say alter, actually it will become higher, okay? Because when there is higher debt in your company's capital structure, the financial risk will increase, and this will require a higher cost of capital. So every time you need to ensure that your debt is in check. It cannot have too high of a debt because it would then push up the cost of capital of your company. Okay, so because different companies, okay, they deal with different types of business. That means they invest in multiple various types of business. This would create a variation in business risk. And also, because different companies have different capital structure, example, some companies will have a 60-40 debt to equity ratio. Some will have 40-60. Some will have 50-50. All right. So because of these variables, that means your business risk and also the capital structure of the organization, what will happen is that the cost of capital for each company will be different from another. So you cannot assume that if this business is in the same industry, they will have the same cost of capital. It's not possible, because even though they are having the same business risk, they are operating in the same industry. What you must understand is that these companies, they may have a different proportion of debt to equity. And when their debt to equity proportion is different, this leads to the company having a different or a varying cost of capital. So no one cost of capital is the same for each companies. Okay. Now, so when we talk about the cost of capital, all right, so I've already gave you the introduction on the cost of capital itself, as in I've already told you what is cost of capital, what does it mean, what is the definition, when would you use it, and what are the main elements in the cost of capital. Now let's go into a little bit more detail where we will look at the cost of equity and the cost of debt. Okay, so what is the cost of equity, guys? What is the cost of equity? So you must know cost of equity is the return required by the equity holders of your company. So the higher the required return, okay, that they require, your company will need to pay them a higher amount. Okay, you need to first understand that when you compare cost of equity and cost of debt, that is a normal behavior. Of course, abnormal behavior also may happen. But when you talk about the normal behavior, when I say normal behavior, what do I mean? So when I say normal behavior, what I actually mean is that for an organization, normally the cost of equity will be much higher than the cost of debt. Okay, so what is the reason that your cost of equity is higher than the cost of debt? You first need to understand the concept of debt and equity. So I'm not sure whether you guys remember, but do you remember as part of chapter 12 when we were learning when we were learning equity and debt finance, we had this discussion where we said cost of equity is so much more expensive than cost of debt. Then I asked you the reason, why is it that cost of equity is so much more expensive? The reason is because, I don't know whether you remember this, but the reason is because this cost of equity, right? Normally, you need to issue this cost of equity. Okay, sorry, you need to issue equity via an exchange. And when you issue this via an exchange, it is expensive. It is highly regulated. There are so many different types of what you call that? There are so many different types of regulations and laws that you have to adhere to. So this makes it expensive for you to invest in the equity. So alternatively, what a company does is they will choose debt, because it's not as highly regulated, it is so much cheaper for me to raise. And by using debt finance, we actually have you actually have a benefit arising. So what is this benefit that arises as part of cost of debt? Is that the company will get tax benefit on interest. That means when you have interest payment, that interest payment will attract a tax benefit where you can save the amount of interest. So guys, all this discussion were actually part of chapter 12. All right. So now, if I continue to talk about why cost of debt is cheaper, it's not only because of the benefits arising from cost of debt, but you also need to understand that on top of the benefits, the organization, okay, will the debt holders would require a lower return, because in an event of liquidation, okay, normally the position of a debt holder is more secured than a position of the equity holder. And as a result of that, because their position is so much more secured, they do not bear a higher risk. And when they don't bear a higher risk, they don't need to require a higher return, because as you know, the risk-return relationship states that the higher the risk that you bear, the lower the return. The higher the return that you get, the lower the risk that you bear, the lower the return that you will earn. So, as a result of that, the cost of debt is always going to be cheaper than the cost of equity. Is there an event where your cost of equity can be lower than cost of debt? Of course, there will be a scenario where that is possible, right? But for the most part, we deal with the cost of debt will be lower than cost of equity, all right? So guys, now what I want to do is I want to proceed to explain about the cost of equity and the cost of debt, as in how we calculate the cost of equity and how we calculate the cost of debt. So we can start with either one, cost of equity or cost of debt. There is no specific manner on you have to start cost of equity then only cost of debt, no such thing. Okay, so when you look at my notes, hold on. So when you look at my notes here, of course I've put cost of debt here and then equity on this side, but you can start with either one, whichever. So I'm gonna choose to start with cost of equity first. Okay, so what is cost of equity? Okay, how does cost of equity work? Why do you need cost of equity? So all those are things that we will cover today. So when you talk about cost of equity, guys, the first thing that I want you to know is when it comes to cost of equity, it actually means this is the return required by the equity holder of the company. Okay, so if I were to explain to you, okay, that cost of equity is always going to be higher than cost of debt, or cost of equity is normally higher than cost of debt. If I ask you why, what will you answer? So guys, remember, you must answer the reason why is because in an event of liquidation, okay, the equity holders would be paid last. And as a result of that, they actually bear a higher risk. So why? Because KE holders, equity holders, actually I shouldn't write KE holders, okay? But this is just for class purpose to make your life a little bit more simple. Equity holders bears a higher risk compared to debt holders, as they are the last ones to be paid in an event of liquidation. So where do you get this information? It's from the creditor hierarchy. So as per the creditor hierarchy, you will see that normally the creditors are paid first, the secured creditors, and then you pay the unsecured creditors, and then you pay your preference shareholders or your hybrid instrument holders, and then finally you pay out the equity holders. All right. So now the next part, how to calculate KE. So you got two methods. The first method is called the dividend growth model or dividend valuation model. Don't worry, I'm going to write it now. Growth model. Dividend valuation model. And you have the capital asset pricing model, which is called CAPM. Okay, so these are the only two models, or these are the only two methods that we use to calculate your cost of equity. Now, we must know both because your examiner can use it interchangeably. Sometimes your examiner can use it to ask you to calculate the dividend growth model or the dividend valuation model. But guys, remember, he don't only use it in this topic, he can use it in the other topics, example, business valuation as well. Okay, so you just need to be a bit more careful. And the capital asset pricing model can also be used to calculate the debt finance. Now, what is this model all about? Okay, so let's first talk about the dividend growth model. Sorry, alignment. Okay, so when we talk about the dividend growth model, guys, don't worry, everything that I'm going to write is actually here, right? It's just that I need to explain further. That's why I'm going to use this particular area. That's why I'm using my document here. But guys, only write those that are important. That means when I'm talking, you listen. After that, only you go ahead and write it. Okay, now, dividend growth model. What is dividend growth model? Dividend growth model is a model that is used to estimate the cost of equity for a company. But you must remember, guys, that when you use the dividend growth model, actually the concept of the dividend growth model is to calculate or to estimate the price of a share, and you can use this formula interchangeably to find what is the KE, because as you know, when there are different unknowns, you can use those unknowns, you will use the information that is available to find a different unknown. So what is the formula? So I must tell you the formula first, then I'm going to explain. So the formula of the dividend growth model or the dividend valuation model is KE equals to D01 plus G over PO plus G. But remember, I told you conceptually, this formula actually is used to calculate PO. PO equals to D01 plus G over KE minus G. Now guys, what I want you to know, what I want you to remember is that when you calculate this particular function, okay, I want you to understand the concept first. So conceptually, what this means or what this formula means is that this formula states that to calculate the market value of a company, all right, to calculate the market value of the company, you will use the present value of future cash flows discounted at the required return of the equity holders, and you will assume that this model, the growth is to perpetuity and they will pay dividends to perpetuity. Okay, so here I'm going to write it now. Market value of a company is calculated as present value of future cash flow discounted at cost of equity with dividend paid to perpetuity and growth of dividend to perpetuity. Okay, so if I want to rewrite this formula, do you know how this will look like? It will look like this. Okay, P0 equals to DO. So I'm going to assume there is no growth, okay, just to make this formula easier for you. DO multiply 1 over KE. So guys, is this familiar? Is this format, is this formula familiar? I think it should be familiar. Why do I say it should be familiar? Because actually, if I replace this value equals to cash flow multiply 1 over R, this actually is the perpetuity formula, right? So you can see here it is growth to perpetuity. So this formula actually assumes growth to perpetuity, and we are assuming, okay, that your dividend must be paid to perpetuity and the company's dividend will grow to perpetuity. So as a result of that, that is why we use the perpetuity formula. So the cash flows, that means the present value of cash flows that we are talking about, the cash flow actually is the return to your investor, which is the dividend. That is the cash flow for a shareholder if they invest in your company, right? And then you discount it at KE because you are discounting it at the return to the equity holder. Okay, so guys, what I want you to know, what I want you to focus on, what I want you to remember is that when you use this formula, actually you can only use it if your dividend grows to perpetuity. If your dividend does not grow to perpetuity, you should not use this formula, because if you use this formula, you are using the wrong concept. Conceptually, you are doing the wrong thing. Okay, now, so this is the dividend growth model. Okay, this is the dividend growth model or the dividend valuation model. So this is your formula for dividend growth model, dividend valuation model. But guys, there is something here that is missing. What is missing? Okay, when you use the dividend growth model or when you use the dividend valuation model, please remember that, okay, please remember that this particular model, okay, this particular model, right, there is one element here of G. What is G? So you already know from what I've explained that G is the growth in dividends. So when I say growth in dividends, okay, what does it represent? Okay, now this shows what is the average growth of your dividends, okay, so that you can use it to calculate your PO. But guys, you must remember this growth, okay, can be estimated in two ways. So I want you to remember that this information here that is given to you, actually you need to calculate it by yourself. That means now I'm saying growth, but in your exam, in your FM examination, the examiner will require you to calculate growth by yourself. You need to know what are the methods that you use to calculate growth. So when you talk about growth in dividends, what are the two methods that you have to estimate growth? So okay, estimating growth, there are two ways. Number one, the historical growth method. And number two, the Gordon's growth model. So guys, for your information, normally the historical growth model is the easy one. This is easy peasy. I'm not lying. This is easy. The only problem is that students normally make careless mistake. Here for the Gordon's growth model, it's a little bit more difficult. Okay, students don't normally like the Gordon's growth model, but if you have the correct technique and correct understanding, I believe that this will be no issue at all to us. All right. So here, when you talk about the historical growth model, what is the formula for the historical growth model? So I know the books have so many different types of formulas, but guys, as I told you, please use my formula, because my formula has been simplified in such a way where it is easy for you to use it. And guys, I'm telling you, like I always tell my students, I've been teaching for a while now, okay, for a few years already. And from what I've been teaching, you must remember that I've had so many lab rats in the past to test whether this formats and formula works. And I've tested it and it works. And since it works, you should have no issue calculating these values. Okay, so growth equals to current over past minus 1. This is my dividend historical growth model. For the dividend, so for the Gordon's growth model, G equals to BR, B equals to retention rate, while R equals to required return. So guys, now before I go into the details of this, I want you to remember a few things. Okay, whenever you do a dividend KE calculation, okay, the calculation for KE, I want you to follow a few steps. What are the steps that I want you to follow? Okay, step number 1, please write your formula. Step number 2, after you write your formula, you identify the unknown. And I'm going to tell you that normally the two unknowns that you will have is G and KE. So from G and KE, the first unknown that you can solve is G. So solve the unknown where info is available. And finally, calculate your KE. So here, what I'm talking about actually is G. You need to decide whether you use the historical growth model or whether they use the Gordon's growth model. Okay, so guys, back to your growth formula. Okay, so I'm not going to go into the details of the growth formula now because then it will be a little bit too much of a mess. So what I'm going to do is I'm going to end this here, and in my next video I'm going to teach you purely how to calculate growth. I'll give you about 3 to 4 examples, and then after we finish learning how to calculate the Gordon's growth model, then I will move to the next part, which is to show you how to calculate the KE using the dividend growth model. And there are a lot more I need to explain about all these formulas. All right, so I will see you guys in the next video.